Hi, this is Adam Khoo here, and I've got big news. Stocks are on sale again. That's right, it's the Great Wall Street Sale. Now, if you've been following my videos, you know that 3 weeks ago I was kind of like warning about a coming stock market correction. And it was pretty obvious at the time because the stock market was really overbought and due for correction. Remember that stock markets don't go up in a straight line. They move in a series of impulsive and corrective wave patterns, right? So what goes up must come down before going even higher. And 3 weeks ago, again, it was really overstretched to the upside and it was due for correction. All it needed was a catalyst. And now it turns out that the catalyst is the coronavirus spreading all around the world and it's freaking people out. That has caused the stock market to really correct sharply down in the last 7 days. So taking a look at the S&P 500, you can see that from a high of 3393, it dropped 16% in 7 days to a low of about 2840. Now dropping 15 or 16 or even 18% is no big in the stock market. It's a healthy correction, right? So in fact, a correction of between 10% or 19%, it's a healthy correction on an uptrend. But what was really shocking about this correction was that it was the fastest drop in history. In fact, if you take a look at this chart, you can see that previously for the stock market to drop 10%, it took anywhere from 190 days to 50 days and so on and so forth. But for this situation, the stock market dropped 10% in less than 6 days. Fastest drop in history. So such a fast and massive drop is scaring the shit out of a lot of retail investors. Because again, like I said, most of the time when a market comes down, it will come down in a series of wave patterns, right? It goes down, it goes up a bit, it goes down, it goes up a bit, it goes down, and so on and so forth. In this case, it was a 90-degree parabolic drop all the way down. So for many people, they didn't have the chance to react. They didn't really have a chance to hedge their portfolios. But I was pretty fast. So what I did was the moment I saw that the price broke a certain level of support, like the first support was the 20 EMA support. Once it broke the support, I began to buy put options to hedge my portfolio. When it broke the 50 support, I bought more put options. It broke the 100 support, I bought more put options. So by using put options, it generates profits as the price goes down. And that helps me to generate short-term profits while at the same time holding on to my long-term investments. In fact, do check out my Facebook page where you can follow many of my live updates, right? So this was a couple of days back. You can see one of my posts over here on Facebook, right? As the stock market crashed yesterday, I made $4,000 by using put options, and I used that short-term profits to buy my favorite stocks at a good discount. So when you have the skills of a professional investor, you can make consistent profits regardless of whether the market goes up or goes down, right? So over here you can see these are what we call put options, and generating profits while the market goes down. Another 2 days later, you can see again the market was down massively, with the Dow and S&P down 1%, but my portfolio managed to get $8,000 up when the market was going down by using put options. So again, it's really useful whether you are a short-term trader or long-term investor to learn how to use put options in order to generate short-term profits as the market is going down. So that gives you extra income to buy your favorite stocks at the discounted price. Now, the interesting thing is that this plunge has been so fast and so widespread that there are many stocks out there of really good companies that are now selling at irrationally low prices, that are deeply discounted, selling below their true intrinsic value. And this is especially true for some stocks that have fundamentally nothing to do with the coronavirus. For example, this stock, which is Lockheed Martin, which makes military defense equipment, right? They've got nothing to do with the virus. In fact, if anything, the US will spend more on defense this year, Okay, another stock is Nestle. Nestle went down as well. What has Nestle got to do with the virus? In fact, because of the virus, people may use more Nestle products. They drink more coffee. They take more instant noodles. Another one would be, for example, Johnson & Johnson, a healthcare stock. Johnson & Johnson went down 15%. It's got nothing to do with the virus. In fact, if anything, people would use more Johnson & Johnson drugs or medical devices for that matter. So why are great companies going down for no reason, even though they're not fundamentally affected by the virus? And why are stocks going down so fast? So as an investor, one of the things you got to understand is that short-term price movement very often has nothing to do with the fundamentals of the underlying business. And that is why a business like Microsoft, where the shares could be worth $180, but temporarily, the next day or next week, because of this drama, the prices could be quoted or selling at $150 per share, which means it's totally mispriced based on the true value of the company. So why does this happen? How do companies get mispriced? Well, this is because 80% of the buying and selling done every day in the stock markets, they're not done by human beings. They're done by machines, robots that are trading not based on fundamentals like sales or earnings or the underlying value of the businesses. But these robots and machines buy and sell based on trading algorithms that are purely based on price action. So you've got millions of all these computers with trading software that are designed to sell the moment certain price levels are reached. So the moment there's a catalyst like the virus and the price comes down, what happens? Once the price hits a certain level, these computer programs are programmed to sell because it hits a certain stop loss level, or the computers are designed to short sell, and that creates more selling. So selling creates more selling, and that's how you got this cascading effect, this domino effect, where prices free fall and they can go to irrationally low levels, which is totally disconnected from reality. In other words, the share price of these companies can go down to a price where it is totally mispriced based on the true value of the underlying businesses. So it is all these robots and algo trading that's creating this massive volatility in the markets today, where the stock market can go up 15% and drop 15% in the next 1 week. So is this good or bad? It depends. If you're like most retail investors who are inexperienced, this will freak you out. This is unnerving. Like, you get confused. What's happening? How can the stocks I bought last week be now worth 15% less? Right? So they freak out, they panic, especially when they read news headlines and the market is free falling and they're hearing recession, epidemic. What do? That's right, they sell, they get out of the markets at the worst possible time. Because I bet you the moment they sell here, guess what's going to happen the next day? That's right, the market's going to go all the way back up again. And they are screwed, they lose money. And they start to feel like the victim and they blame. They say the market's manipulated, it's not fair. Which is true, the market is manipulated, right? But you can take advantage of that to make money. I'll show you how in a while. But again, the trouble is most retail investors, they get caught up in their emotions and they sell at the worst time and they buy at the worst time. So they lose money. And as a result, many retail investors, at the end of the day, they say, the stock market is too crazy for me. And they rather put their money into time deposits or fixed deposits or bonds where they feel more certainty. Now, the trouble with that is that in the long run, their wealth will be destroyed because of inflation and lower interest rates. So you got to understand that short-term certainty creates long-term uncertainty and wealth destruction. But when you learn to train yourself to take advantage of short-term uncertainty, it will lead to long-term certainty and wealth accumulation. Now, as professional and experienced investors, my students and I, we love volatility. Volatility is our best friend. Why? Because volatility creates the temporary mispricing of businesses. And that's how I get really rich. I get really rich because I buy great companies when they're temporarily discounted and the share price is selling way below the true value of the company. And the only way to be truly confident in the businesses you're invested in is to know how to calculate the intrinsic value, or know how to value the businesses based on its cash flow, its assets, its debt, right? So in my value momentum investing course, I teach my students on how to value businesses. So for example, I know for a fact that Amazon is worth $2,400 per share. That's the true value of Amazon. So in the short term, no matter where the price goes, the price can go to 1,008, it can go to 1,002 because of all these computer selling. Doesn't bother me because I know that eventually it's going to go to $2,400. In fact, Amazon is going to increase in value over time, where I know in the future it's going to be worth $3,000, $5,000, even $10,000 per share. I know that. It's a matter of time. For example, look at Facebook, right? Facebook, I'm confident the intrinsic value is $261 based on its current cash flow, its earnings, and its growth rate of number of customers. If you look at Microsoft, right, I'm 100% confident that Microsoft is worth $205 per share. That's the intrinsic value. So again, when I have this confidence that it's worth that value in the short term when people are panicking and selling their shares at low prices, what am I doing? I'm buying their shares. So you can bet that last Friday when people were panicking and the market was over here, right here, when people are selling in panic right at the bottom, I was buying shares. I was buying Microsoft, I was buying Johnson & Johnson, I was buying Amazon, I was buying Facebook, because I know, you know what, it's going to go higher eventually once the short-term panic is over. So if you think logically, you can see, for example, Microsoft was being quoted the price at $190 1 week ago. Now the price is being quoted at $150, 20% less. Now think logically, do you think Microsoft as a business is worth 20% less in a week? Of course not. It's the same business. People are still using Microsoft products. They're still using Microsoft cloud computing. Your business has not changed. It's not a computer virus. It's a human virus. Nothing to do with Microsoft, right? They're still making the same sales, making the same profits. Same thing with Amazon. People are still ordering shit online. People are still looking at Facebook every single day. The business has not changed. The only thing that has changed is that the price is being quoted at a different price because, again, like I said, machine and robotic algorithmic trading. And so the price you see now is a mispricing of what the stock is really worth. So when you can disassociate emotionally and think logically, you can take advantage of people's fear by buying their shares at a huge discount. So understand that the stock market is like one giant roller coaster, all right? And on the roller coaster ride, the only people who get hurt are those that jump off the ride halfway. If you stay in the ride and hold on for dear life, you want to close your eyes, I bet you're going to reach the destination eventually, which is a lot higher prices and tremendous wealth in your portfolio. Now, of course, this assumes that you get on the right roller coaster, right? If you get on the wrong roller coaster that's poorly maintained, it could derail, crash, and never come back. And so the most important thing is to only include fundamentally very good companies in your portfolio with wide economic moats, with a track record of consistent sales, profits, and cash flow, and low debt that can support its valuation. So let me give you an example. If you look at Tesla or Beyond Meat, now these are really exciting stocks that can make you a lot of profits as a short-term trader. And yes, I do trade them short-term, but these are not stocks I would dare to include in my investment portfolio. Why? Because they do not have a track record of consistent sales, profits, and cash flow. In fact, they are both still losing money. So these are stocks for trading and not meant for investing. So if you want to find out what the fundamentally best companies to include in your investment portfolio, do subscribe to the Ultimate Investor's Playbook, where you can see exactly the stocks I buy and sell every single day and how I construct my portfolio, as you can see, where I diversify between defensive stocks, cyclical stocks, and growth companies and ETFs. And again, the stocks that I talk about in my investment playbook is very different from stocks that we trade in the stock trading chat group. All right? So before you start to panic and sell a great company in your portfolio because of short-term uncertainty and epidemic and panics, let me remind you of something, right? Just 5 years ago, Amazon was selling at $697 per share. And because of, again, some bad news during that time, there's always bad news, right? H1N1, mad cow disease, North Korea, Iran, there's always some shit happening in the world, right? So I can't remember what shit happened then, but some shit happened that caused panic. And again, from $697, Amazon fell to $486, a 30% plunge in 1 month. And sure enough, there are people who freaked out, they panicked, and they sold, right? But if you had the faith in the business, if you knew what it was truly worth, people are still ordering things on Amazon. They're still a monopoly in e-commerce, and you held on to those shares. Today, in 2020, from $486, it's worth $1,800, right? That's almost a threefold increase in less than 5 years. And that's the power of investing in great businesses. Over time, they will always rise. So I'm very confident Amazon is going to be worth $2,500, $5,000 in the future. So no matter how low it goes today, I don't care. I just buy more shares. Now, am I saying that we're at the bottom of the correction right now? That we are not going to go lower? I'm not saying that. We could still go lower. But temporarily, we're going to at least bounce from here. Why? Let's look at some of the technical elements of the charts, right? So looking at the S&P 500, it has dropped continuously for 7 days, down 16%. And right now, it is what we call oversold. It's like a rubber band. You're stretching a rubber band, it's going to snap back up. So before the market opens later today, I would bet it is going to bounce today. Why is it going to bounce? Because it's oversold. You can see on the stochastics, it is way below 20 and it's due for a bounce. If you look at the Bollinger Bands, the price has exceeded the lower Bollinger Bands, so it's oversold on the Bollinger Bands as well as the stochastics, right? It's oversold. Not only that, but last Friday we closed with a bullish candle sitting on a support level, right? So there's high probability that we are going to bounce up today in the market, right? We're going to bounce up. Now, here's the thing. What's going to happen after the bounce? Let's check it out, right? So after the bounce today, am I saying we're going to go all the way back to a new high? Honestly, I don't know. I can't predict the future. So there are two scenarios right now. The first scenario is that after we bounce tonight, we're going to hit some kind of a resistance level. So it could be one of the moving averages, like it could hit the 100 moving average or hit the 150 moving average. And once it hits that moving average, it could create the next leg down. So we could go lower. It is a possibility that the economy slows down a lot more and we could go into even a bear market. It is possible, but I don't think so at this stage, but anything could happen. Or we could bounce strongly today and we could then go to a new high, all right? So what's going to happen? No one can predict the future. So what am I doing? So once it's oversold and stocks are cheap, I don't buy all at one time. I perform what is known as dollar cost averaging. So for example, if I wanted to add 100 shares of Facebook, I don't buy 100 shares right now. I may buy 20 shares. Why? Or 25 shares. So if it does go back down lower, no worries, I'll buy another 25 shares. Every time it keeps going down to a support level and is undervalued, I will keep adding more shares. So I have a good average because I can't always catch the bottom. But I know that eventually when it bottoms and the market recovers to new highs, I'm going to make a lot of money. Does it make sense? Okay, so never buy all at once. Always buy in stages, as long as it's at a good level of support. Now, at the same time, to hedge my portfolio, what I'm going to do is this. When the market bounces up and hits a level of resistance, I'm going to put in more put option spreads. And I'll talk about this in my next video on how to hedge your portfolio using options. So by using put options, if if the market comes back down lower again in the next leg, the put options are going to make good short-term profits for me. So I can use these short-term profits to help me to buy more shares of good companies at bigger discounts. All right. So it remains to be seen whether again we're going to go for another leg down or we're going to recover to new all-time highs. Okay. Now again, bear in mind that right now we are not yet in a bear market. A bear market is defined as a drop of more than 20%. Currently, we're in a correction. So a correction means it's still an uptrend. We are still on an uptrend. If you look at weekly candles, you can see that the major trend is still there, right? And right now we're here. We could go all the way down to hit this 200 moving average on weekly candles. So we could still go down another 5% more, and that's fine. We're still on an uptrend. This is a correction and is going to go higher eventually. So for now, it's still a correction and not a bear market yet. So if it continues to be a correction, how long would the correction last? How long will it take to recover to new all-time highs? So let's look at some statistics courtesy of Goldman Sachs presented on CNBC Research. So you can see that since World War II, there have been 26 market corrections. And the average correction has been about 13.7% drop over 4 months. So the average correction takes 4 months to play out. And right now we are only about less than a month into it. So I'm not surprised that it continues for 3 more months going sideways or even going down a bit more. That's fine. And it on average takes another 4 months for the market to recover to its previous high points. All right, so there you go. All right, so stay safe, especially physically stay safe, as well as in the markets. May the markets be with you. Take advantage of this opportunity, but do note it could go lower. So average in your positions and learn to use options to protect yourself and profit during the short-term downward moves. And again, more on that on the next video on hedging. Watch out for my next video. So if you want to be the first to get my next video on YouTube, do click the subscribe button right now. If you want to check out my online courses, go on to piranhaprofits.com where you can enroll in our professional Forex, stock trading, options trading, and value momentum investing courses where you're going to learn how to trade like a professional and generate an income anywhere in the world. If you would like to come to Singapore to attend my live classes, Wealth Academy, go on to wealthacademyglobal.com. It's Adam Khoo, and may the markets be with you.